The collapse of the Silicon Valley Bank has rocked the financial markets. Founded in 1983, SVB specialized in banking for tech startups. It provided financing for almost half of U.S. venture-backed technology and healthcare companies. SVB was among the top 20 American commercial banks, with $209 billion in total assets at the end of last year. Last week, the bank collapsed in just 48 hours, but it all began a year ago when the Federal Reserve began raising interest rates to tame inflation. The Fed moved aggressively, and higher borrowing costs sapped the momentum of tech stocks that had benefited SVB. Higher interest rates also eroded the value of long-term bonds that SVB and other banks gobbled up during the era of ultra-low, near-zero interest rates. SVB's $21 billion bond portfolio was yielding an average of 1.79%. The current 10-year Treasury yield is about 3.9%. At the same time, venture capital began drying up, forcing startups to draw down funds held by SVB. So, the bank was sitting on a mountain of unrealized losses in bonds just as the pace of consumer withdrawals was escalating. SVB announced that it had sold a bunch of securities at a loss, and that it would also sell $2.25 billion in new shares to shore up its balance sheet. That triggered a panic among key venture capital firms, who reportedly advised companies to withdraw their money from the bank. The bank's stock began plummeting Thursday morning, and by afternoon it was dragging other bank shares down with it as investors began to fear a repeat of the 2007 through 2008 financial crisis. By Friday morning, trading in SVB shares was halted, and it had abandoned efforts to quickly raise capital or find a buyer. California regulators intervened, shutting the bank down and placing it in receivership under the Federal Deposit Insurance Corporation. Technology workers whose paychecks relied on the bank were also worried about getting their wages. An SVB branch in San Francisco showed a note taped to the door telling clients to call a toll-free telephone number. Silicon Valley Bank's failure is the largest since Washington Mutual went bust in 2008, a hallmark event that triggered a financial crisis that hobbled the economy for years. The 2008 crash prompted tougher rules in the US and beyond. Despite initial panic on Wall Street, analysts said SVB's collapse is unlikely to set off the kind of domino effect that may cause a financial crisis. But while a broader contagion is unlikely, smaller banks that are disproportionately tied to cash-strapped industries like tech and crypto may be in for a rough ride. According to analyst calculation, U.S. banks lost over $100 billion in stock market value 2 days after the SVB collapse, with European banks losing around another $50 billion in value.